Okay, good afternoon everybody. My name's Kim Reynolds and I've got Brett Griffiths here with me. We're here today to present the quarterly tax and superannuation update. For those of you that are regular listeners to our webinars, you'll note that this time we've combined the seminar or webinar presentation. It's for two reasons. I guess one is to make the presentations a bit more concise for everybody. It also helps us out a little bit this quarter, she says somewhat jokingly, in that the last quarter has been relatively slow on the tax and superannuation front. We've still scheduled the session for about an hour, and I'll speak for the first half hour and Brett will do the super update in the second half hour, or the second part. But usually in the last quarter of a financial year we've got a flurry of activity that happens, flurry of legislation that's introduced and passed as a result of the budget that happens in May. This year, however, has been slightly different to what I can remember from prior years. The budget, as I'm sure you all know, it's been heavily criticised from most sectors of the community in one way or another. We've also got a change of the Senate that happened on the 1st of July. So as a result of both of those things, we've got a number of budget measures and also election campaign promises that are still not finalised. So that's given, I guess, a bit of time for the dust to settle on everything else that's been happening, but also leaves us with quite a number of unknowns that are coming out of the budget in May. So Brett and I have picked out some of the happenings in the past quarter, and we'll discuss these together with some things that we thought we should point out for people to keep in mind for the next, as we enter into the new financial year. So to start off on some of the, I guess, the more mundane tax issues, threshold changes that happened on the 1st of July. We've got Division 7A benchmark interest rate changes. That rate's come down from last year. It's 5.95 down from 6.2. The CGT improvement threshold, which for some reason I've had to deal with quite a lot lately. That's having an impact on a number of calculations that we've done recently. So that's also been uplifted for the 2014-15 year, that should say, not 14-16. The car limit it remains unchanged at 57,466. So that will continue along the same lines as in previous years. I guess one thing just quickly to mention in the context of the Division 7A benchmark rates, I know that we all use Division 7A facility agreements and loan agreements of various types in our firms, and it's probably a good time at the start of the year to revisit some of those and see whether, if you've been using agreements for a number of years, just see whether they're still relevant to your client's circumstances. If you haven't updated them for a number of years, then it's worth revisiting just to make sure that there hasn't been any particular change that might be impacting on the agreements that you're putting in place for clients. And also, I've noticed in recent times that some firms are using various forms of UPE facility / investment agreements for the changes in the approach that the ATO put in place in 2009 for making UPEs fall under the Div 7A umbrella. So it's worth revisiting or visiting those to make sure you're putting the right agreements in place, speaking to your legal advisors to make sure that you've got something in place that you can actually provide to clients. We're not legal advisors, so we can't be drafting those sorts of agreements. So making sure you've got some sort of license agreement with a legal firm that can draft those agreements properly for you. Okay, so on to some news as far as on the legislation front. The Mineral Resources Rent Tax Repeal Bill, that was passed by the House of Representatives in late June. I think it was about the 27th of June that was passed. Now the repeal of that legislation also impacts on a number of other tax-related measures, things like the loss carryback rules, You can see there on the slide the low income superannuation contribution, school kids bonus, income support bonus. Also the capital allowances for small businesses, changes that were to take effect from the 1st of January this year, and the super guarantee charge percentage increases. Now all of those are dependent upon the passing of the MRRT repeal, and although it passed the House of Representatives in late June, it is in the Senate at the moment, and as I said at the outset, the change of Senate on the 1st of July, that'll be an interesting Senate to watch for the next few years. I think there'll be some interesting decisions that come out of there. I noticed that yesterday the crossbenchers, and particularly the Palmer United Party, made comment about they were happy to vote for the repeal of the MRRT, but there were some of the aspects that are listed there on the slide that they weren't so keen on getting rid of. So the government's going to have a bit of a battle on its hands for the next little while in relation to the items that have community support, I guess, as opposed to the MRRT side of things. So that's a little bit of a watch this space, possibly for quite a while. One piece of legislation that has been passed is the temporary budget repair levy, and this was announced in the budget. This levy was introduced across 15 bills, so it was a bit of a challenge to see how it all was intertwined, but the effect of it is that from the 1st of July this year, so from last week till the 30th of June 2017, there'll be a 2% levy on an individual's taxable income where they earn in excess, where their taxable income is in excess of $180,000 per annum. So that's taking effect now. Effectively means that the top marginal tax rate from the 1st of July is 49%, because it was 46.5%. From the 1st of July we had an increase in the Medicare levy, bringing it up to 47%, and now with the 2% levy on top, we've essentially got a 49% tax rate. So keep that in mind when you're doing your planning for clients and working through potential outcomes for clients. I know I was in a meeting with a client the other day and proceeded to calculate the tax at 46.5% and had to remind myself that it was no longer relevant. So keep that in mind. Also, for those that are doing some planning around the 2% levy, there was some talk initially about the fact that and across these 15 bills you would think that everything would be covered, but although the levy started from the 1st of July, the FBT rate will only increase from 47% to 49% on the 1st of April next year. So there's essentially a 9-month period where individuals that are earning more than $180,000 may have an opportunity to salary package certain items and have fringe benefits as part of their package, where they only pay 47% on the fringe benefit, brings their taxable income under the $180,000. So it's only a 9-month window. You'll need to revise the packaging arrangements from the 1st of April next year, but something to keep in mind if you've got clients that are in that sort of range that might want to do some planning around that. One item I thought we should point out, and I'm always saying that the world's becoming a much smaller place. This is one example of how small it is getting, that on the 1st of July we had a start date for what's referred to as the Foreign Account Tax Compliance Act, FATCA, which is basically a US tax evasion measure. And for those of you that have any dealings with clients that are either US citizens or have been there for a while and may be regarded as US taxpayers, then you need to be very aware of the existence of this legislation. Essentially what it is, it's a tax evasion measure that is targeting untaxed income and assets that are held by US citizens around the world, and basically through assets that are held through banks or other financial institutions outside the US. Now the Australian government's entered into, under this legislation, it was going to be the obligation of the financial institutions to provide information to the IRS in the States in relation to all of the affected taxpayers, and that was going to be a administrative burden on the financial institutions. So most countries have entered into arrangements through their tax authorities to provide that information to the US authorities. So essentially what happens is that if you have a US citizen that banks with, say, one of the big 4 banks here, if they fall into one of the categories that needs to be reported, then the bank here will report the relevant information to the tax office here, and the tax office will then provide that information to the IRS. So it's I guess an opportunity for the tax office and the IRS to talk a little bit more about the taxpayers in both countries and exchange information. But it's important for us to just be aware of that when we're dealing with clients that might be coming from other countries, that this is an obligation that will be there. So there may be further questions that pop up from either the US authorities or even the Australian authorities as a result of this new sharing of information. The information that's reportable under the rules is basically the account holder's name and address, the account number, the bank account, their US tax identification number, so their tax file number in the US, the account balance and value of the balance at the end of the relevant year, and the name and identifying number of the Australian financial institution as well. There are certain circumstances where there's an obligation to report gross deposits and withdrawals, or total amounts of dividends and interest and income from other assets that are held in the account, or the proceeds from the sale or redemption of property. So as you can see, it can be quite all-encompassing, and need to be aware of it. You should know, however, that there are some exclusions from the accounts and products that are exempt from this legislation. That includes certain retirement and pension accounts, some regulated non-retirement savings accounts. There are certain employee share schemes that fall outside, or employee share trusts, term life insurance policies or accounts held by deceased estates, and some escrow accounts as well. So I guess, like I said, just be aware that it's there, and if you start getting more questions from one or both tax authorities, then you know why. The next thing I just wanted to mention was in relation to charities. There's been a lot of talk since the new government took office about the reform of the charity sector, the not-for-profit sector. We had the ACNC introduced by the previous government, and the new government has indicated that it's not a big fan of that commission. So this, on the 4th of July last week, the government introduced a paper for consultation on replacement arrangements. So this paper basically looks at policy directions to reduce the burden of regulation, which is what I thought the ACNC was doing, but they're obviously not of the same view. So it's going to look at things like the self-reporting requirements, the compliance framework surrounding the not-for-profit sector. They're obviously going to need some transitional arrangements to move from the existing set up to whatever's put in place, and also looking at how you determine the charitable status of an entity to the tax office. So if you've got any clients or you've got a particular interest in that sector, then there's an opportunity to review that consultation paper and make a submission if you so choose. Project DOIT was a project that was introduced earlier in the year by the ATO. DOIT actually means Declare Overseas Income Today. It's a program that the ATO introduced in an effort to encourage taxpayers to disclose offshore assets and income, and it's an example of how the ATO is stepping up its data mining program. The the outcome of this, where taxpayers do disclose their offshore assets and income, is that they will be assessed for the last 4 years. They'll have a shortfall penalty of 10%, but full shortfall interest charges. And the ATO have indicated that there will be no investigation by the ATO, or the matter wouldn't be referred for criminal investigation either. Now, this project DOIT closes on the 19th of December 2014. I understand that there have been a number of disclosures already made, as well as a number of expressions of interest, I think I saw it referred to as, where taxpayers have identified themselves and indicated that they will be making disclosures. So far, the ATO has recovered about $13 million in tax liabilities. So that's from the 160 odd that I think that have disclosed so far. And essentially it's looking at the ATO's reviewing information from overseas tax authorities on Australians with offshore investments and bank accounts, where they've got interest and account balances in other jurisdictions, looking at money transfers to and from offshore bank accounts. And in particular, they're looking at countries where we have I guess they're considered to be low tax countries. So examples are Switzerland, Israel, Liechtenstein, the Netherlands, South Africa and Hong Kong. So it's something that if you've got clients that, like I said, that the world's becoming a smaller place, it's not unusual for people to have dealings in other countries and those countries. So it's if they've got dealings in those other countries, having a look at what it is, whether everything has been disclosed and whether it's it would be prudent to make a disclosure to the ATO prior to the closing of this project, because I imagine that once the 19th of December passes, it'll be gloves off, and the tax office will be not extending any favours to people after that date. The next thing I just wanted to mention was over the last, I think for the last 12 months, I think every update that I've had, I've mentioned a tax case on residency, and I think in just about every occasion the ATO has won those cases, whether they've been at the AAT or at a higher court, where they've talked about the residency of a taxpayer and essentially deciding that the taxpayer was a resident of Australia, so therefore we had taxing rights on all of their income. This recent case I think it was at the end of May, basically it was a case of Dempsey. There was a taxpayer located down at the Gold Coast. He was determined to be a non-resident taxpayer, so that's a bit of a turn-up. The case basically goes through, and I think on the facts it was agreed that he was domiciled in Australia, but there was a question as to where his permanent place of abode was. And it's an interesting case to have a look through if you've got clients where you're trying to determine whether they're residents or non-residents for tax purposes. That question of where somebody resides and where their permanent place of abode is sometimes quite a tricky one to determine. It's very much based on the facts of each individual case. There's no cookie-cutter approach to it. And this case, I guess, demonstrates the extent of detail that you have to go into to determine whether somebody is a resident or not, and whether they do reside somewhere or have a permanent place of abode somewhere, and the factors that will be considered. It's not just a matter of saying that somebody's been in the country or out of the country for 183 days. It's looking at what they're doing day to day, what's their mode of life, was the old terminology, how they, even though they might be employed somewhere else, this person was employed in Saudi Arabia, I think. It was questioning where he went on holidays and how long he went on holidays to those places, how often he came back to Australia. He had family back here, so did he come back and visit them? He had a place to come back to, like a residence to come back to, but wasn't really his home. The numbers side of things as to, when you fly in and fly out, those things are fairly easily accessible these days from the tax office and customs perspective, but it's a matter of really looking at what the person's doing from day to day, and if they're employed somewhere else, are they really living there, or are they just there as on a fly-in, fly-out sort of arrangement? They're there because of the work and that's it, but their home is somewhere else, or have they made a life somewhere else? It also, for those of you that have got clients that are doing work in the Middle East, there are a number of countries in the Middle East where it's not possible to buy property, and as such the employers over there tend to provide accommodation for their workers, and that's always in the past been one of the indicators that the tax office have used, that, well, you don't have a property over there, you didn't buy anything, you're just renting, and it's your employer that's organised it, so that counts against you as being able to be a resident of that other place. And in this case they acknowledge that it's, in Saudi Arabia particularly, that it's not possible, wasn't possible for the taxpayer to buy a property over there. It just isn't allowed by law, so the employer had to provide the property, and the weighting of that factor tended to work in the taxpayer's favour in this case, which is not what's happened in the past. So, like I said, for those of you that have got clients that are working in that part of the world, there are quite a lot of cases that work the other way, that the tax office have decided that, and the courts have decided that the person is a resident of Australia, but this one gives some indications of some of the arguments the other way that it's worth taking note of. Other point I just wanted to raise with people was transfer pricing. Again, with people doing more and more work overseas, setting up entities overseas to start business expansion, dealing with related entities, and there's money transferring back and forth because there are services being provided between Australia and the other jurisdiction, or the other way around. Most first world countries have transfer pricing rules, and those basically require that transactions between entities take place on an arm's length basis. Our transfer pricing rules have been revisited in the past 12 months as part of the whole base erosion profit shifting focus that the governments internationally are taking, and the focus of our changes has resulted essentially in our record keeping requirements being a bit more onerous and costly to maintain than they have been in the past. They require that the records are kept contemporaneously. They need to be prepared prior to the tax return being lodged for the relevant year, not afterwards. If they're not prepared prior to the return being lodged, then there won't be a reasonably arguable position in the case of any dispute or audit that the ATO may embark upon. So it's important to be aware of what those rules are. Have a look at, there's a ruling and a practice statement there referred to on the slide, TR 2014 D4 and PSLA 3673. So they basically together outline what documentation is required and what the tax office will be looking for if they were to undertake a transfer pricing review. Yes, so it's just a good thing to be aware of. Failure to lodge penalties. I'm not sure about you guys, but I'm seeing a lot more of these penalties being sent out on a seemingly random basis at times. But so, 10 years ago, if a practice statement was released on how the tax office deals with failure to lodge penalties, people might not have taken much notice of them. But I think in the current environment, it's worth having a look at and being aware of what's in there. The practice statement provides guidance to ATO officers when they're dealing with certain things. So in this case, dealing with and administering the 75% penalty for failure to lodge a return or notice or other document by the due date. The ruling pretty much explains the circumstances in which an entity is going to be liable, how the penalty is going to be assessed and how it may be remitted. So if you want to challenge the penalties, then you need to understand all of those things. Examples in the practice statement of when remission might be contemplated is where there's a genuine mistake by the taxpayer. You need to be able to demonstrate that it is a genuine mistake, something that's happened beyond the taxpayer's control, whether there are credits available to offset the tax liability, or where, it was interesting wording, but they say where there's been extraordinary cooperation by the taxpayer during any examination by the ATO. So yeah, so if you're getting these notices and you want to challenge them, then have a review of that practice statement, because it'll give you some handy hints on how to deal with it and whether you've actually got a shot at challenging it in the first place. Activity statement changes. Some of you may have noticed or recalled we sent a VinLink article newsletter out recently about the ATO moving to electronic statements. So essentially from the 1st of July 2014, where one of the statements outlined, one of your electronic statements, or sorry, one of your ATO statements is provided to the taxpayer electronically or lodged electronically, then all future statements are going to be provided electronically. Now, all the statement types, excluding the ones listed below, will be affected. So if you're dealing with clients where they have, there's a bit of a combination going as to who prepares the information for the statements and who lodges it. Sometimes the client wants to prepare it, but the firm actually lodges it, tax agent lodges it. Then need to be careful as to how that's managed to make sure that if you still want a paper version of the statements coming through, that the electronic lodgements are not don't trip that up. But if you've got any questions about it, I refer you to the VinLink article that we did send out a short time ago. I mentioned a little while ago about the data matching and data mining that the ATO is doing in respect of Project DOIT. The ATO, one of the ATO senior officers made a speech recently on how the ATO is going to transform its tax administration with technology. I think we've seen some evidence of that with the MyGov services, which hasn't received such a good rap, I'd have to say, in the last week or so, because it's crashed when people have tried to lodge their returns. But I think from a bigger picture perspective, the increased use of the technology by the tax office goes along the same lines as the Commissioner is saying that he wants to bring the tax office into a new age. The use of technology, as we all know, can make things a little tricky because things become a little bit more automated, so there's not so much common sense, let's say, in how some things are dealt with, but it also makes some things easier to deal with, and because it's automated. So the ATO's view is that this increased use of technology is going to improve compliance. It'll make interactions easier because they don't have to. There's not so much interaction required for mundane type items. But the cynical part of me says that it'll also increase the ability for the ATO and government departments to obtain information, data match, and exchange information between them. So there'll be an increase in review opportunities. The last 12 months we've seen a marked increase in the level of review and audit activity from the ATO in various areas, comprehensive risk reviews or client reviews. So it's just inevitable that that's going to be more and more in the next in future years, but with this increased use of technology. So unfortunately we can't put our heads in the sand. We need to be aware of it and deal with it, and I guess get on the front foot to try and make it as smooth as possible and educate clients that it's coming. Now, the last thing I wanted to mention before I hand over to Brett is just a quick mention on the Queensland Budget. This budget came out the first week in June. Again, there wasn't anything terribly exciting from a tax perspective. The changes were really minor or administrative nature, so I've just highlighted a couple there. Now, a land tax exemption being available for land that doesn't receive a home exemption because the taxpayers changing their home that straddles the 30th of June, so that's an issue, and there was no technicality perspective, there was no way to deal with that as far as the law was concerned. And also a concession for transfer duty on the transfer of land used for family primary production business, where it's by way of a gift, that exemptions to be, or concessions to be expanded to allow it to apply across a wider range of family relationships, so nephews and nieces, etc. So if you've got people that are clients that are in that space, then again it's worth considering and raising with the legal advisors to make sure that it's taken advantage of. Okay, so that's all from me. I'll hand over to Brett now.
Excellent, thanks for that, Kim. I suppose firstly I'm going to start off with an update on the whole Superstream regime. You may recall that I've spoken about this before because it was the elephant in the room that was coming very quickly. Literally at the last minute, the government released an announcement essentially saying they were going to delay the process. Now, what that means essentially is that there's more dates that we need to be aware of, but that doesn't necessarily mean that the employers have to abide by those dates. So to go back a step, Superstream is essentially a requirement by employers when they make superannuation contributions to provide certain information electronically, as well as make the payment electronically. Now this obviously means that the super fund needs to be able to receive the contribution electronically, which 99% of funds I'm imagining would. I don't think there'd be too many financial institutions that will still have bank books. Now, one thing I should quickly point out too is that Superstream is actually does not relate to related party employees, so they're excluded from the regime. So the change that came, or that was announced, is that essentially if you have an employer that has more than 20 employees, then it depends on where those contributions are being channeled to. So if they're going to the large APRA regulated type funds, then the employer has to comply with Superstream by the 3rd of November 2014. However, the APRA fund can actually request an alternate start date if they go to the Commissioner before the 3rd of November, and that can be up to 1 July 2015. So if the trustees of the fund go to the Commissioner and say, hey, you want an extension until 1 July, the Commissioner can then grant that. Self-managed super funds have an automatic extension until 1 July 2015 if the employer has more than 20 employees. If the employer size is less than 20, so for small businesses, then they are not required to comply under the Superstream regime until 1 July 2015 for APRA funds or 2016 for self-managed superannuation funds. So it was essentially a 12-month extension for self-managed funds and only a couple of months for APRA funds, because APRA funds are meant to have been onto this essentially by earlier this year, by January this year. However, self-managed super funds shouldn't just sit back and go, right, we don't have to worry about complying with Superstream now until 1 July 2015, so we won't worry about doing anything. I was recently talking to a client that their software, payroll software, actually would not let them essentially process any contributions for a self-managed super fund unless they had their EMS details, so the electronic messaging service details. So bear in mind that although there is not a legal requirement, there may be a practical requirement for self-managed super funds to jump on the bandwagon essentially early. And at the end of the day, the trustees or you as the advisors should have already been getting clients used to this concept, so you might as well just roll them out as required. Now, across our client base, we've got about 450 funds. We would have had less than 100 funds that are implicated in Superstream. So at the end of the day, it's not a very large or onerous obligation that we need to be a part of. But what it also means is that as you're doing the 2014 financial year tax work, you can see, well, okay, yes, they've had employer contributions from an unrelated party. Let's make sure that we now provide them with the necessary forms so they can give that to their employer. So that's essentially the approach we're taking, and I would suggest that you might want to do the same. Now that information they need to provide to their employer, as a bit of a recap, essentially it's just the fund's ABN, the bank account details for the contribution payment, and that electronic service address. So for argument's sake, it might be Macquarie, Australia Post have one, most software providers have one as well. So there's, on the previous slide, there was a list of the, down the bottom there's a list of the providers that are a part of this. That's all up on the ATO website. And you can just go to the ATO website and search Superstream and you'll find it quite easily. And as I've mentioned, some software providers have their own EMS arrangements, so that's the easiest way to handle it in reality. ATO administrative and directive penalties. Now once again, this is something I've spoken about before. However, it's come into effect from last week, so it's worthwhile just mentioning again. Now, I'd also share some insights that I've had with the tax office, talking to Stuart Forsyth, who's the Assistant Commissioner of Compliance inside the tax office, and how they're going to approach it. So as a bit of a recap, this legislation now provides the ATO as regulator with the ability to provide trustees a rectification direction or an education direction. So where it believes that the trustees have breached this. Now what that really means is a rectification direction is where the tax office tell the trustees in writing how they need to fix the contravention. And this direction will specify the action required, and the trustee must then provide evidence to the tax office that it's been fixed. And obviously it has to happen within the time period as specified. If they don't, then there's 10 penalty units will apply. Those penalty units, it's $170 per unit. Education directions. Now this is essentially where the tax office can say to the trustee, hey, you need to go and get educated on how self-managed super funds work or how the legislation works. The tax office last week actually provided their guidelines, if you like, as to what these education direction providers will need to cover off. To my knowledge, there aren't any of those as yet. However, they can't actually charge for the course, so it'd be surprising if many, if any, commercial operations will actually go to the time and effort and cost to put a course together when they're not actually going to get remunerated for it. But essentially, these education directions will require the trustee to undertake a course and to provide evidence that they've completed their course within the specified time period. Now the administration penalties, that's an interesting scenario essentially. For those that have been around in superannuation, particularly self-managed super as long as I have, may remember back in 1999 when the tax office first took over administration of the self-managed super funds. There was a lot of concern that it was essentially putting Dracula in charge of the blood bank, that the ATO would be looking to make as many funds non-compliant as they could because the tax rate was top marginal, plus Medicare. The reality has been over the past 15 years that hasn't been the case, which is great. So, but I suppose those suspicions, if I can call it that, were again raised when these penalties came into play as to how the tax office would actually administer those. Because essentially it's an automatic penalty that the tax office have to impose. When I was talking to Stuart Forsyth, I actually asked him, were they looking to change the audit report or the mechanisms for which auditors of self-managed super funds would be going back to the tax office, so then literally the tax office just issue the speeding fines along the way without actually needing to get involved in the process. Thankfully that's not the case, so there is obviously still pressure on self-managed super fund auditors not to contravene funds. However, there's not an immediate penalty, if you like, by them doing so, which I'll talk about in a second. Now, the interesting thing in how this legislation works is that the penalties are applied to the trustees. So essentially, if you have individual trustees, each trustee is levied with the penalty. Now, some of these penalties can be 10,000, or can be quite significant, as you'll see in a second. So each trustee is liable for the penalty. Whereas if you have a company, it's the company as trustee that is levied with the penalty. So essentially the directors share that as jointly and severally. So there can actually be a situation where there is a greater advantage in having a corporate trustee in place rather than individual trustees. Bearing in mind that about 70% of all self-managed super funds have individual trustees rather than a company. So this essentially adds more weight to the benefits of having a corporate trustee, particularly a special purpose company. They only have to pay $45 now to ASIC for their lodgement fee annually. So it's just essentially a one-off hit to set up the company, which can potentially pay benefits along the way. Now, the sting in the tail essentially with these penalties is that the trustees are the ones who are imposed the fines, the penalties. They cannot be reimbursed from the fund, and the fund cannot pay them initially. So it's designed to come from the trustees' back pocket, so they personally feel the pain of the penalties that's been imposed upon them. And the ATO obviously must notify that they have imposed the penalties, and they can remit them. However, it's an automatic process that they have to impose the penalties, and then you have to go back to them and say, hey, we think that's unfair. We believe that a rectification direction or education direction would be more appropriate in this circumstance. So the onus of proof essentially will be on the trustees and their advisors. So what is the mechanism, and how will these penalties actually be imposed? Basically, the process will be as it is now. The SMS auditor will do their job and they'll report a breach if there is one, and via a contravention report. The ATO will then essentially risk rate that contravention, or the fund I should say, in relation to that contravention. So three categories: low, medium and high. Low is where there's one or two minor breaches and there's been no previous breaches of the trustees before. The ATO in that case will classify that essentially as a low risk. A medium risk is when there's a few more breaches involved, once again more minor breaches, or they might have also had some previous breaches. So in prior years, the tax office might rate them a little bit higher as far as their risk matrix. And a risk rating of a high is essentially where there's been a major breach, so in-house assets, loan to members, that sort of thing. So the penalties for that, well, the implications I should say for that is when the tax office will then rate that as a high. So what does that all really mean? Well, basically a low risk, the letter will come from the tax office saying, hey, you've had a breach, don't do it again. A medium risk is when the tax office will actually make a phone call to the trustees of the fund, and they have actually indicated it will be the trustees, not the tax agent. And given the ATO's data matching capabilities, as Kim mentioned before, we're certainly seeing more and more contact essentially directly with trustees of self-managed funds. And a high risk is where the tax office will undertake a desk or a field audit. They've indicated they want to do more field audits, so they'll turn up to their accountant and essentially go through everything. And what's, I suppose, also important to note is that for a medium risk, if the ATO make a call to the trustees and they don't really like the responses they're getting, then they will move them to a high risk and instigate a desk audit. So basically, and the reason why that's important to note is that the ATO will impose penalties as a result of their desk or field audit. So if they undertake an audit and they agree with the auditor that yes, there is a breach, then they will from that automatically issue the penalties and fines, and then it's up to the trustees to determine if they want to come back and say, hey, we don't think that's fair. Now essentially the way that the penalties regime work is that there's a list of sections that prohibit or that apply to this regime. So I've covered these off before, so I'll quickly, I suppose, talk about the more prominent ones. Basically, Section 65, which is loan to members or related parties. That's the most common form of contravention notice the tax office receive. About 60% of all breaches relate to that, according to the latest stats. Now, that penalty is $10,200 per trustee. So if you have 4 trustees, that's $10,200 per individual trustee. Now what's also important to note is that these breaches come into effect if the tax office fine them from 1 July 2014. But if you had a breach that was for the 13 year that carried forward to the 14 year, there would be a breach for the 13 and for the 14 year if that loan, for argument's sake, hadn't been rectified. So they can basically look backwards and determine you've breached in certain time periods, or for certain different breaches, it can mount up essentially or aggregate into quite a large sum of money. Some of the other bigger ticket items, I suppose, prohibition against the borrowings. So if a super fund borrows money, or in-house asset provisions, they're all 60 penalty units or $10,200 per trustee. Some of the more interesting ones are the record keeping for the trustees, how they have to keep those for 10 years. If they don't, it's $1,700. Now what's interesting with that is if you have trustees that change accountants, some of those accountants are saying, well, we don't hold any records of the fund. Now that potentially could put trustees in an awkward situation because the trustees may be assuming that the accountant is actually keeping the records of the fund. So that's just something for trustees to be aware of, and obviously as advisors, if a trustee is actually implicated with those fines or those penalties, they may potentially come back to you and look for a restitution of those penalties because you haven't essentially done what they thought you were going to do. So your engagement letter becomes quite important in those situations as well. And I suppose the other big ticket item there is you must notify the regulator significant events immediately. So potentially if the fund is insolvent, looking to wind up, that sort of thing, you've got to notify them. So changes for insurance from 1 July 2014. Essentially a super fund will only be able to provide members with insurance that aligns to a condition of release under the SIS regs. So that being death, permanent incapacity, temporary incapacity, or terminal medical condition. Now, what that really means in a nutshell is that from 1 July 2014, a super fund cannot provide trauma insurance to members, and also the TPD insurance. The restriction as to the own occupation will also be removed, so will also be applied. So you can only have TPD insurance where there is an any occupation definition in there. Now it's also very important to note that existing insurance policies that were in place before 1 July 2014, they're grandfathered, as with everything in super, all these grandfathering provisions we have, so they can keep on going. So it's just no new policies that can be essentially put in place. It's worthwhile just mentioning the contribution caps. So 2015, the general contribution cap $30,000 for anyone who's under the age of 49. Anyone who is 49 or older, as at 30 June 2014, can do $35,000. And the non-concessional cap is now $180,000 a year, or if the member is under 65, they can use the bring forward of $540,000. Another thing that I thought it was worthwhile just putting onto the radar is the accountant exemption that is sort of pretty fast looming as far as what accountants need to do, in essence, to provide self-managed super fund advice to their clients. So as you may recall, from 1 July 2016, for an accountant to provide advice to their clients on self-managed super, they need to hold their own licence, AFSL licence, and that could be a full licence, or it could also be a new type of licence that's been introduced called a limited licence. A limited licence is where you can provide on a class or category of product, but not be specific about it. So you could talk about shares for argument's sake, but you can't talk about BHP shares. Or alternatively, the accountant could become an authorised rep of an existing AFSL holder. Now, interestingly, since 1 July 2013, so in the last 12 months, only about 20 or 30 accountants have obtained a new limited licence. Now, granted, there's still a couple of years for this to happen. However, Treasury estimates that about 10,000 accountants are going to apply for a limited licence. So just quietly, ASIC are a little bit concerned they're going to get smashed with about 6 months to go from about 9,000 accountants demanding their limited licence. So they will not have the resources to process them in a timely manner, which means the accountant might not actually have their licence in place by 1 July 2016 to talk to their clients about their self-managed super funds. So I just thought I'd just mention that as a little bit of a heads up. Because obviously time flies very fast. You know, we've already had this in place now for 12 months, and the next 2 years will move very quickly. And finally, I just thought I would mention an estate planning case that has had a bit of prominence of late, McIntosh and McIntosh. Now, the reason why this is interesting is that essentially it was the first time that the question was asked that if a person was eligible to receive a deceased super person's benefits, where they're also the legal personal representative, must it go to the estate or can they receive it, personally? Well, Justice Atkinson decided that in this particular case, the mother was she was the legal personal representative and also nominated, although it was a non-binding nomination, by the 3 super funds that her son was a member of, and they're public offer super funds, so 3 big funds, and the trustees of those 3 big funds paid it out to her personally, even though she was also the legal personal representative, because she was nominated on the forms. Now, essentially, Dad took Mum to court to say that he didn't think that was fair because the will divided things up differently. Now, Justice Atkinson decided that the mother was actually required to move the money to the estate for the super benefits, so essentially hand them over to the estate and be processed through the will, even though the trustees of the super fund followed the non-binding nomination by the member to pay that to Mum. So this has some pretty big implications, because really what it means is that in a lot of cases the legal personal representative will also be the beneficiary. So that opens up a whole new avenue of potential litigation to obtain estate benefits, even though they've been dealt with correctly, essentially, via the trustees of the super funds. It also means that trustees of large super funds are more likely just to pay it out to the estate and ignore any nomination that the member may have made, because they obviously don't want to be caught up in these sort of actions. A binding death benefit nomination, however, would have completely changed the outcome of this particular case because they are binding on the trustees, so they would have had to pay it to the member directly. So once again, from an estate planning point of view, it sort of highlights the benefits of the binding death benefit nominations and their importance that they play in our estate planning for our clients. So, in winding up, that was essentially the last 4 months in a nutshell in the tax and superannuation regime. Realistically, as Kim mentioned from the outset, there hasn't been a lot of new stuff, which in some ways is good because we've all been quite busy dealing with our clients' affairs. So I suppose really now we look forward to what the Senate will be doing over the next few months and what that may then mean for the changes in legislation. So if there's no questions, then we'll move on. But please, don't be afraid to email us if you have any questions about this topic, or just generally if you want to talk about a general client query that you have using your 15 minutes free consultation. So with that, I'll bid you farewell and have a good day.